Chapter 7, we'll talk about our first assets, cash and accounts receivables. So first we have cash and cash equivalents. So you have to remember that cash is not only currency on hand. So say your Lowe's or Home Depot, you've got all kinds of cash in your cash registers, but it's also the balances that are in your checking account or your savings account. And many times companies have multiple checking accounts, like for payroll, for accounts payable, they have money markets, etc. Well, that goes into cash equivalents. But so also in our cash equivalents, those are where like those money market funds are. Treasury bills, notice though what we have in the bullet point there, as long as it's no more than 3 months out. And then commercial paper, which would be like a bank type of an investment. Internal control is extremely important, especially when we're talking about cash, because that is obviously the asset that is going to be the most susceptible to theft. So we want to have good policies and procedures in place to minimize errors and theft. We want to promote operational efficiency. And then ultimately the goal is to have accurate and reliable financial information. So our Sarbanes-Oxley Act, which came into effect in the early 2000s after we had the fall of Enron, and then they took down Arthur Andersen, one of the big auditing, international auditing firms with them. So when those things happened, the government came along and created the Sarbanes-Oxley Act, where publicly traded companies have to have documented internal controls in place, and they have to be audited by their independent auditors. The Committee of Sponsoring Organizations is who kind of oversees the internal control process. And again, it goes back to wanting to have effective and efficient operations and reliable financial statements. So separation of duties when we're talking about cash receipts. So we would have one employee who opens the mail and prepares a list of all of the checks. So the check number, check who paid, the dollar amount, and then a separate employee is going to take those checks to the bank and deposit them in. Then when the deposit receipts come in, a third employee actually puts it into the general ledger. So obviously, if you have a big accounting department, this is possible. One way that this is kind of streamlined is if you have a lockbox at the bank, in which case the checks go directly to the bank deposits them directly into your account, and then you get a listing of who paid, and it doesn't involve any of your employees. So that can make that a little more efficient. Cash disbursements is when we're paying out, so we want to have internal control procedures that help prevent any unauthorized payments being made, and then also just ensure that those disbursements that are correct are recorded properly. So most of these disbursements could be made by check, or they could be made by wire transfer. They need to be properly authorized, and then if they are checks, it should be signed by, normally it's like the controller or the CFO, somebody like that. Businesses can have restricted cash where it's set aside for a specific purpose. And then if that would just be based on what the company wants to do. If it's contractually imposed, then it's saying that there's like, maybe we have bonds or we have a bank loan and we're required to have money set aside, possibly to pay it off, or at least to pay off the interest. Sometimes banks will also require you to have a compensating balance. So they may give you a loan or a line of credit, but then they'll say, in order to have this low interest rate, you have to leave $25,000 in your bank account at all times. And then if you drop below that, then you're going to pay a higher interest rate. So here is an example. The company borrows $10 million from the bank at a rate of 12%. The bank requires a $2 million compensating balance in a non-interest bearing checking account. So they're going to borrow $10 million. If they are, this is what this is trying to say is then 2 million of that though is restricted. So they're paying only the 12%, but because they can really only use 8 million of it, it's really charging them 15%. So having those compensating balances doesn't always, make sense. If you could get a loan without it, a lot of times banks do require it though. Then our next type of asset that is most common is our accounts receivable. So anytime we are recording revenue and billing out our customers, they're not paying us right away, that goes into what's called an accounts receivable. And we give them terms on those invoices. So maybe 30 days, 60 days, and they're current assets because they'll normally be obviously paid in a short period of time. So we always record our revenue at the amount of the obligation, or like we just had in the last chapter, we might allocate that based on when the performance actually occurs or when we actually earn it. And then these were some of those different complexities that we talked about in that chapter. So when we are offering our credit to our customers, we could give them two different types of discounts. We could give them trade discounts if we're selling products. We might say, hey, if you buy a large quantity, you can take 10% off the price. Or if you market our product, you could take 15% off the price, something along those lines. Sales discounts are in the invoice itself, the terms of the invoice, and it gives them incentive to pay early. So what is down here in the red are some common terms if we're going to offer a discount. And how it's read is you get a 2% discount if you pay in 10 days. The net invoice is due in 30 days. So if they pay in those first 10 days, they can take 2% off. So then here's an example. So because at the time that we're recording the sale, we don't know that they're going to take the discount. So we could use the gross method and just put it into accounts receivable at the 20,000 and record the sales revenue and then record a sales discount at the time that they take it. Or we could choose the net method where we just record it in the accounts receivable at that 98% and record our revenues at 98%, our sales. But then then here, when they pay us, if we're using the gross method, then we calculate the discount that they've earned based on what they paid, and we take it out of our accounts receivable at the gross, and we set up this new contra sales account at 280. So a contra sales account means it goes the opposite direction of sales. Sales are normally a credit balance. Sales discounts would be a debit balance. And on our income statement, they would reduce the sales. If it was the net method and we already recorded the whole 2%, we're going to just record what got paid because we already recorded the whole discount. But then in this case, they didn't take advantage of the terms. So when they pay at the end of the 30 days and we're using the gross method, we just receive the cash and we take it out of accounts receivable. If we've already recorded the sales discount, then in the net method, then we're going to have to adjust it because they didn't take advantage of it. So we'll take it out of the accounts receivable at the net, and then we'll credit our sales for the discount that they did not take or the discount that they lost. So then here they're just showing you that. In the end, you end up with the same amount. It's just how does it get recorded? Then, as if you're selling product, you almost always have to know that some of those products are going to be returned and they're either going to get a credit on their account or ask for a refund. So we will set up an allowance for those customers, and we will, the second bullet point that uses that word allowance, that's saying we will give them an allowance. Like say they have defective material or something's a little bit off with it, we'll give them a break and say, hey, if you keep it, we'll deduct $500 off of what you owe us or something along those lines. So what we want to try to do eventually, so this is saying that if we sold it in 2024, we're going to have that whole profit. But then if some of that merchandise gets returned in 2025, our profit in 2024 is overstated, and then our 2025 is understated. So what we want to try to do is account for it and set up an allowance for those returns. So here we have, again, we had sales at $2 million that had a cost of $1,200,000. Industry experience tells us that 10% of those sales are going to be returned. So $200,000 is what we anticipate is going to come back. And then the customers actually returned $130,000. So when we had the sales, these would be our entries to record the sale and then to record the corresponding cost of goods sold. Then as the returns would come in, we would debit our sales returns and either pay them back or give them a credit on their account, depending on which way it goes. And then if they were not defective goods, they're going to go back into inventory at their cost. So then we're going to debit the inventory and then credit out the cost of goods sold again because the merchandise came back. If we expected, so again, we expected 200,000 total, 130 came back. So we still think there's another $70,000 of returns that could come back to us. So then we're going to create a liability for those. We're going to debit our sales returns, so that contra account that's going to offset our sales, and then we're going to create a liability, and then we're going to put it into an estimated return inventory account and credit our cost of goods sold. So then now we have that cushion that when those returns do come back into 2025, we're going to just take it out of that. So we would, so say they all came back in, we're going to debit that refund liability, and then we're going to credit our cash when we're paying the people back or giving them credit. And then we're going to put it into real inventory and then take it out of the inventory estimated returns. Now, if we were just wrong, if those 70,000 really never came in and only 60,000, again, we're going to have to adjust it. So reverse what we wrote off, so then take it out of our liability and then take it out of the sales returns, and then reverse it by debiting our cost of goods sold and crediting that inventory estimated returns. So that in effect zeroes out what we had estimated. So we just basically are reversing part of that entry. Then later on, so it's after it's sold, after it's past the return windows, we're trying to collect on our accounts receivable. Not all of our customers will pay us. So, many times there's bad debt. So there's two different methods that a company can use. And obviously we're really going to focus on the allowance method, which is GAAP. So direct write-off method is not GAAP because it doesn't properly value our accounts receivable to get it down to that net realizable value. And it distorts our net income because it's going to throw the bad debt into a future period. So at the time, though, if we were following it, we would just debit bad debt expense and credit accounts receivable when we realize that the company is not paying us or the customer is not paying us. But again, following GAAP, we want to record an allowance. We want to estimate what do we think will be uncollectible and then record our accounts receivable at that amount. So we have different ways to do it. So we're always going to debit our bad debt expense, and it's not going to be when we recognize the account as uncollectible. We're going to recognize it in the period that the sale happened, but it's going to be an estimate. Then later, when we do determine, hey, this accounts receivable is the one that is not going to be collected, we will write it off to that allowance. So here's an example. Again, sales of $1,200,000. They've got $350,000 left at the end of the year, and they are going to recognize that some of that's not going to be collectible. So they think they'll only collect $280,000 of it. So they're going to debit bad debt expense for the difference and then credit this new account called allowance for doubtful accounts or uncollectible accounts. And that is a contra asset account. Its normal balance, assuming it's operating properly, should be a credit balance. Then when we determine, hey, this customer is declared bankruptcy and they're not going to pay us, we will debit the allowance for uncollectible accounts and we'll credit their receivable, and that will take it off of the books. Then if by some chance those people paid us, we would have to put it back into their accounts receivable and then put it back into the allowance so we could use it for another customer. And then we would receive the cash payment the same way as we always do. So we can use the balance sheet approach where we're focused more on what's in our accounts receivable. We could use what's called a current expected credit loss model, where we're looking at each customer account and applying a percentage to come up with what that total is. Or we could use the aging method where we prepare an aging schedule in each different category. Again, the older it gets, the larger the percentage that we estimate is not going to be collectible. The more recent ones have the lower percentage. And then just mathematically take those percentages times the total to figure out what that allowance account should be. And then we have to, anytime we use that method though, we have to look at, well, what's in the allowance for uncollectible accounts already? Because it's a balance sheet account, it doesn't automatically zero out, it carries forward at the end of the year. So when we do our balance sheets methods, again, any of those three methods, we come up with a balance. We look at what's in that account right now, and then we just do the journal entry for the difference. So that pink number is the difference that we need to book to bring the allowance up to the value that we want it to be. Now, let's say it was the other way though. So like I said, the allowance for uncollectible accounts should be a credit. Let's say it's a debit, then we have to correct that. We have to get rid of the $2,000 debit and then add the $40,000 ending balance that we want it to be. So then our journal entry is going to be a debit to bad debt expense for $42,000. Okay. Now the income statement approach is a little bit easier because we don't have to factor in what's in the allowance. We just take our sales and multiply it by a set percent. So if our sales are 1,200,000 times 2%, that's going to be our bad debt expense, and that goes into the allowance for uncollectible accounts. Now, we may combine them. So here it says our quarterly financial statements are not quite as important as our year end. So maybe on a quarterly basis, we don't want to go through all the work of analyzing the aging and each individual account in there. So we might do an income statement approach for the quarters, but then when we get to the end of the year, go through the aging and make sure it's completely accurate. So again, recognition of our revenue. Most of our credit sales are going to go into receivables at the time that they're delivered. They should be valued at that net realizable value, what we expect to receive. So that might be minus those sales discounts, minus sales returns. It'll be adjusted by this allowance for uncollectible accounts. And then our accounts receivable are always a current asset. Now our notes receivable, that is when we extend like debt to a creditor. So maybe say it is not a creditor, a customer. So maybe say the customer had 30 days to pay and they couldn't make it and they asked for longer terms. So we may allow them longer terms in a short-term interest-bearing note, but we're going to charge them interest. So we're going to charge them simple interest. So it's principal times rate times time. And then we'll calculate out what that interest is, and then we will record it. They'll pay us at the end. They will pay us principal plus interest, but we're definitely going to segregate it to say it's the interest income or the interest revenue. Now, if it crosses over the end of the year, we want our financial statements to be as accurate as possible. So we need to accrue the interest that they owe us. So we'll figure out how many, in this case, it was August 1st to December 31st, so 5 months. We'll set up a receivable and we'll record the interest revenue. But then when they pay us, we have to remember to take it out of that interest receivable, and then the remaining month of interest would go to interest revenue in the next year. Non-interest bearing notes normally do have interest associated with them. It's just not a stated amount. So then this one kind of goes into a discounting or a time value of money to say how much are we getting at the end, and then we'll infer some interest. So if we accept a $700,000 note for goods that normally have a sales price of $658,000, there's an inferred amount of interest of $42,000, and we'll record that as a discount. So anytime we get the interest in advance and they don't pay us at the end, we call it a discount instead of, well, again, it wouldn't be receivable because they're not paying us at the end. So it's a discount on that note receivable, and then when we record it as revenue, we'll debit that and credit the interest revenue again once it's earned. And then this is again showing you how to calculate if they basically are paying $42,000 for that $658,000, what rate of interest is that? What's the effective rate? And then calculating that out. And then it would be the same thing if that non-interest bearing note crosses over years. We would want at the end of our fiscal year to record that interest revenue that was earned, and again put it into the discount, and then when they pay us it would come out, or that discount would get recorded just for the current revenue. Sorry, it doesn't come out of it because again we already collected it. It's netted in the beginning. Okay, so then here is some journal entries that show you again, because now this one's long term, it goes over 2 years. So first we record the notes receivable and we record the discount on that notes receivable. Then at the end of the year, we record what revenue we've earned. And then the end of the second year, we record the remainder of that revenue. So then at the end of the term, after the notes receivable is done and paid, that discount on notes receivable is 0, and all of the interest has been recorded as interest revenue. If we just actually loaned money, so we gave $700,000 cash to another customer, again, we're going to set it up the same way, put it into a notes receivable and receive the cash, but then we may, and we'd record the interest and all that stuff the same thing. But if we were in the habit of giving these short-term notes out, we have to think about them the same way as we do in accounts receivable, that there could be some that don't pay us. So we would want to also have an allowance for those loan losses, again, that might not get paid. Then we can finance with our accounts receivable. So we could pledge them as collateral on the loan, and then as we collect the accounts receivable, we should then forward that money to the loan to help pay it off. We could sell the accounts receivable where then the buyer's going to do the collection on their own, and then we would have a gain or a loss. Normally there's a fee involved in that, so you actually pay to do it. You can pledge your accounts receivable, so it's not specific receivables that are associated with the loan. It's just the entire basis of the accounts receivable are securing that loan. And then there'd be no special accounting treatment needed journal entry wise, but you would have to disclose it in the notes to the financial statements. So if they assign particular receivables to act as collateral, then they are going to collect the money and that lender's going to charge them an upfront financing fee, and then the receivable could be collected by either party. So it depends, because the customer could pay directly to the bank, and then the company's out of it completely, or they could pay the company, and then the company in turn then pays the bank. So then here's the example, but see, notice there's always a charge. So banks are not going to do this just out of the goodness of their hearts. So there's always going to be a finance fee. So in this case, it's 1.5% of the accounts receivable that are assigned. And then there's also going to be interest that's going to be charged. So then so go back, the $400,000 loan, sorry, this one's a $500,000 loan at 12% interest. So that interest expense is at the 12, oh, I see, because it's only for 1 month, sorry. So it's only for 1 month, so then that is why it is the $5,000, but it's still at that 12% for the $500,000. Then if we sell them, we're going to remove them completely off of our account, and we're going to recognize them at the fair value and then have a gain or loss. If we factor them, then the financial institution is going to charge a fee for that service, and then they're going to be responsible for collecting from the customers. If we sold them without recourse, it means if our customers don't pay, they can't come back at us and try to get that bad debt. If we sell it with recourse, then the bank could come back after us if our customers do not pay. There could also be a discounting, which again is going to be taken like off the top or at the beginning, and there is a financing fee involved in that as well. So $200,000 note at 10%, but the bank is going to discount it at 12%. So then we accrue the interest at that 10% that it is for, but then we are going to be paying that 12%. So we've got the face amount of the note plus the interest that's being charged at 10%. So then our maturity value is what is going to get the 12% discount fee. So then the $215,000 times the 12% for the 6 months, the bank is going to give us $202,100 if they are discounting that notes receivable for us. And then this is just kind of a nice little account or a nice little page that shows you all the different ways that we could finance those receivables to get the money quicker. And then everything is going to be disclosed in the notes to the financial statements, anything that's associated with any of these types of leveragings. Okay, then you have to be able to compute these ratios. So we have the accounts receivable turnover ratio, which is our net sales divided by our average accounts receivable net of the allowance. So that is going to give us how many times do we turn that accounts receivable over. But sometimes that's hard to know. Does that seem good or bad? So the average collection period goes hand in hand. If you take that accounts or that receivables turnover ratio and you divide it into 365 days, that'll give you how many days. Then you could compare that to your terms. Another internal control procedure that deals with cash is our bank reconciliations. This is in the appendix, but I do think it's important to understand bank reconciliations. So you'll have some questions on your homework and your quiz and your test. But so a bank reconciliation, we take the balance per the bank and we compare it to the balance per the books, and we recognize that there's going to be some differences, and we got to figure out what those are. So we first look at our balance per the bank, we look at our balance per the books, and then we adjust them. So this is our common way. So the balance per the bank we need to add any deposits that are outstanding. So any, like we deposited at the bank, maybe in that overnight depository box or drawer, and it doesn't get deposited into our account till the next day. We wrote checks that are in the mail, or someone hasn't taken them to the bank to cash yet. Those are checks outstanding. Then our balance per the books, it has those deposits and those checks already recorded. What does it not know? It doesn't know things that happened at the bank. So the bank charged us service charges. Maybe some of our customers' checks that we deposited bounced. And now we got to go back after those customers, but we didn't know it till we got our bank statement. If anyone like wired money into our bank account and we didn't know about it, we would pick up all of those when we're reconciling our bank account. And then those two balances, once we go through those adjustments, they have to equal. So then here they give us an example of the balance that is adjusted. They give us, this is the bank balance, right? So they give us checks, deposits, service charge, NSF checks, and a note that they collected. And this is our balance per the books. And then we come over and we want to try to reconcile that. So we've got our balance per the bank statement. We add any deposits in transit, which is the details of that are given to us up above here, number 1 and number 2. And then we deduct our checks outstanding, which is number 3. And that is our corrected not bank account, but book balance. Then we go to the bank and say, okay, our balance that was our balance per the bank. Then our balance per the books, we look at it to say, okay, what happened in the bank that we don't know about? So we didn't know about the service charges. We didn't know about those NSF checks. And we did not know about the note that was collected. And then there is $1,000. If you look over here at number 4, we wrote a check for $1,790, but for some reason it only got cashed for $790. So then we owe that another $1,000, but we have to adjust our balance so we know what it relates to. So then we would also need to record those journal entries. So here are the journal entries that we would need to record. So we collected on a notes receivable. We had bank service charge. We had customers' checks that went NFS. And then we still owe a supplier. Or the supplier payment was incorrect. So it goes to accounts payable. Then some companies will have a petty cash box. The petty cash box is normally a small amount, maybe a few $100s. And if they're paying, like going to buy stamps or paying for a pizza or paying delivery fees, things like that, it's easier to do it with petty cash than giving those people like company credit cards or checks. So at the end of the month, we're going to look at what did we disperse out of our petty cash account, and then we will do a journal entry to record it. So what they show us down here is the journal entry that initially sets up the petty cash account. Then as we use it up and we replenish it, at the end of every month, we will write a check to replenish it, but then we need to charge all of the receipts that we have. And then that is it for our first chapter on our assets, our cash, and our accounts receivable.